Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 2. This is Section G1. This is a remembering and understanding topic. Understand the accountant's responsibilities with respect to laws and regulations that have a direct effect on the determination of material amounts or disclosures in an entity's financial statements for an engagement. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it's free, it is 1 hour, and we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time. And after you watch that webinar, you're going to want to learn more, so make sure you check out becoming a SuperfastCPA Pro member. In today's video, we're only going to be going over 5 questions, and normally SuperfastCPA Pro members get access to the full 10-question versions of these videos. Now, to be honest, this video will only be 5 questions for YouTube and 5 questions for members because it's a fairly small topic, and so I felt like we covered enough in just 5 questions for YouTube and for members. But again, most of the time, these videos are 5 questions on YouTube, but there are an extra 5 questions for members on the SuperfastCPA forum. So if you like this and you like our other videos, just know that SuperfastCPA Pro members typically get access to the full 10-question versions of these videos. Now with that, let's dive into the questions for this video. All right, here we are at question 1, and one strategy I always like to point out when it's an option is to read the last question or the last sentence of a question first. Now, it's not always going to be helpful, but very frequently it will be, because frequently the last sentence of a question gives you the context for what the question is actually about. Now, in this case, it's not going to be super helpful, but again, this is a habit that you want to be in specifically for test day, because on test day, you have no idea what you're going to be seeing in the questions. So if you read the last part of the question first, you will very frequently know, oh, I'm dealing with laws and regulations in this question, or whatever the case is. Again, this is a good habit to be in no matter the situation. Let's do it in this case, just again to be in the habit. How should Mark respond? Let's go up to the top. During an audit of Grandview Manufacturing, the engagement team identifies a recent regulatory change affecting environmental reporting requirements. The audit manager, Mark, instructs the team to assess whether Grandview has complied with the new law. During the discussion, a junior auditor asks whether the audit team is responsible for ensuring that Grandview remains compliant with all applicable regulations. So again, how should Mark respond? Let's go through the options. Option A, the audit team is responsible for preventing noncompliance by ensuring that Grandview follows all applicable laws and regulations. Option B, the audit team must design procedures to detect all instances of noncompliance, as they have an obligation to prevent material misstatements arising from violations of laws. Option C, management is responsible for ensuring compliance with laws and regulations, but auditors should assess the effect of noncompliance on the financial statements when relevant. Or option D, the audit team is required to report any suspected noncompliance to the appropriate regulatory authorities, regardless of its effect on the financial statements. All right, with that, we've gone over the options, and if you have no idea what we're supposed to be doing in this situation, that is okay. We are going to use these questions to learn about this topic, so let's go ahead and dive into the explanation to start learning. All right, here we are at the answer. C, management is responsible for ensuring compliance with laws and regulations, but auditors should assess the effect of noncompliance on the financial statements when relevant. Okay, so that's the answer. Let's go through the explanation to understand that a little bit more. Auditors are not responsible for preventing noncompliance with laws and regulations. That responsibility lies with management. However, auditors do need to consider whether any identified noncompliance has a material effect on the financial statements. If a law or regulation directly affects amounts or disclosures in the financial statements, auditors should obtain sufficient appropriate evidence regarding compliance. Now let's talk about why the other options are incorrect. Option A was incorrect because auditors do not ensure compliance. Again, we just talked about that. Their role is to assess financial statement impact, not prevent noncompliance. Option B was incorrect because while auditors do consider noncompliance, they are not required to design procedures to detect all violations, only those materially affecting financial statements. And that's something that we've talked about in multiple audit videos. Almost always, if something says that they're going to detect all violations or detect all errors or things like that, almost always that's wrong, because that's almost impossible to do. So again, auditors are focusing on what's materially affecting the financial statements. And then option D was incorrect because auditors may need to report noncompliance in some cases, but they are not automatically required to report all suspected violations to regulators. So we learned a little bit about the responsibilities of auditors when it comes to noncompliance with laws and regulations. Now let's go to the next question. All right, here we are at question 2. What level of assurance does an auditor provide regarding material misstatements in the financial statements resulting from noncompliance with applicable laws and regulations? Let's go through the options. Option A, absolute assurance that no compliance has occurred. Option B, reasonable assurance that the financial statements are free from material misstatement due to noncompliance. Option C, limited assurance that the entity is in full compliance with all applicable laws and regulations. Or option D, no assurance as auditors are not responsible for considering the effects of noncompliance on financial statements. All right, so based on the first question, you probably already have one or two of these that sound much more likely than the other ones. So pause the video, think through this, and when you're ready, come back, we'll look at the answer together to learn a little bit more about this. All right, here we are. The answer is B, reasonable assurance that the financial statements are free from material misstatement due to noncompliance. And, that kind of was inferred in the first question, so hopefully you got that. Now let's talk about the explanation. Auditors provide reasonable assurance, not absolute assurance. Again, going back to that where if you ever see anything that's saying that auditors are going to provide absolute assurance or catch all errors or things like that, that's almost always going to be the wrong answer. So again, auditors provide reasonable assurance, not absolute assurance, that the financial statements are free from material misstatement, including misstatements resulting from noncompliance with laws and regulations. Reasonable assurance means that while auditors perform procedures to detect material misstatements, there is still a possibility that some misstatements, including those related to noncompliance, may go undetected. Now let's talk about why the other options are incorrect. Option A was incorrect because, again, absolute assurance is not possible because audits are conducted on a test basis and inherent limitations exist, and we've talked about that throughout multiple videos. Option C, incorrect. Auditors do not provide assurance that an entity is fully compliant with all laws, only that material misstatements due to noncompliance are not present in the financial statements. So again, they're not sitting there making sure they're complying with every single law. They are just trying to make sure that they catch any noncompliance that is materially going to affect the financial statements. And now let's talk about option D. That was incorrect because auditors do consider the effects of noncompliance when assessing the risk of material misstatement, and we learned that in the first question. All right, let's go to the next question. All right, here we are at question 3. If an auditor becomes aware of information suggesting potential noncompliance with laws or regulations, what steps must they take? Let's go through the options. Option A, obtain an understanding of the matter to evaluate its potential effect on the financial statements and perform procedures to determine whether noncompliance actually occurred. Option B, immediately report the issue to regulatory authorities regardless of its impact on the financial statements. Option C, assume management will address the issue and continue the audit without further action unless there is clear evidence of material misstatement. Option D, withdraw from the engagement as auditors are not responsible for investigating potential legal violations. Now again, this is another one of those situations where just based on these options, probably one or two of these sound much more correct than the other ones. So I think you could probably reason your way through this in just a short amount of time. Pause the video, think through this if you want to, and when you're ready, come back, we'll look at the answer together. Okay, here we are. The answer is A, obtain an understanding of the matter to evaluate its potential effect on the financial statements and perform procedures to determine whether noncompliance actually occurred. Again, that one was probably not too difficult once you read through the options, so let's read about this explanation. When an auditor becomes aware of potential noncompliance, they must first obtain an understanding of the situation to evaluate its implications for the financial statements. And that makes sense. They have to make sure they understand kind of what's going on to be able to know if it's going to affect the financial statements. They also need to perform appropriate audit procedures to determine whether noncompliance actually occurred. If noncompliance is confirmed and materiality affects the financial statements, the auditor may need to take further action, such as modifying the audit opinion or communicating with those charged with governance. Now let's talk about why the other options were incorrect. Option B was incorrect because auditors do not automatically report noncompliance to regulators. We learned that in the first question. Reporting depends on legal and engagement requirements, and if it's material. Option C, incorrect. Auditors cannot assume management will handle the issue without performing their own evaluation. Option D, that was incorrect as well because withdrawal is not an automatic response. The auditor must first assess the facts and determine the appropriate course of action. They may withdraw in some situations, and we're going to talk about that in another question, but again, they're not going to automatically withdraw if they find that there might be some noncompliance. With that, let's go to the next question. All right, here we are at question 4. When an auditor becomes aware of a potential instance of noncompliance with laws or regulations, what is their role in determining whether a violation has occurred? Now let's talk about the options. Option A, the auditor must obtain an understanding of the matter, but does not have the authority to make a final determination of noncompliance. Option B, the auditor is responsible for concluding whether the entity has violated laws or regulations and reporting their decision to management and regulators. Option C, if the auditor is uncertain about whether noncompliance has occurred, they must assume the worst case scenario and modify the audit opinion accordingly. Or option D, the auditor must conduct a full legal investigation to establish whether a violation has taken place before completing the audit. All right, so again, based on these options, you probably can kind of think through this and find one or two that seem more correct than the other ones. Think about this, think about what we've learned so far in the other questions, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer. A, the auditor must obtain an understanding of the matter, but does not have the authority to make a final determination of noncompliance. Let's talk about the explanation. Auditors are responsible for obtaining an understanding of potential noncompliance to evaluate its effect on the financial statements and to kind of see if they think that something's happening, but they do not have the authority to legally determine whether a violation has occurred. That decision is made by a court or relevant regulatory authority. If uncertainty remains, the auditor may need to consult legal counsel or consider the impact on the audit opinion. So again, the auditor is responsible for trying to gain an understanding and trying to understand if something probably did happen, but again, they are not the ones that are going to rule or say this is in non-compliance. If they're unsure, they're going to have to figure it out with a court or with legal counsel or things like that. Now let's talk about the other incorrect options. Option B was incorrect because auditors assess the financial impact of potential non-compliance, but do not make final legal determinations, and we just said that. Option C was incorrect because auditors must gather evidence and assess the situation, but they should not assume the worst without sufficient basis. And that kind of goes with professional skepticism. Professional skepticism is about having a questioning mind, but it's not about automatically assuming people are lying or that fraud is definitely happening or that the worst case scenario is going to happen. It's just kind of being aware and questioning things and making sure that they seem correct. Now let's talk about option D. That was incorrect because auditors are not responsible for conducting full legal investigations. Their role is limited to evaluating the financial statement impact. All right, with that, let's go to the next question. All right, here we are at question 5. And again, this is one of those situations where we read the last part first. It's not always going to be helpful, but I'm trying to get you in the habit of doing this. What should the auditor do? Let's go up to the top. An auditor identifies material noncompliance with laws and regulations that affects the financial statements. As a result, they modify the audit report to reflect the issue. However, management refuses to accept the modified report and insists the auditor issue an unmodified opinion. So again, what should the auditor do? Now, we haven't talked very much about unmodified, modified opinions throughout my video so far because that is actually one of the last things that you talk about in the audit blueprints. So we'll get there eventually, but basically just to kind of clarify that, unmodified opinion means that the auditor is going to say that things are presented fairly, there's no issues that they can see. But a modified opinion or some kind of modified opinion says that something is kind of wrong or they're unsure if something's wrong because they weren't able to find out all the information or all the evidence. Again, that's kind of the idea there. So in this case, the auditor finds this, modifies their opinion, but management is refusing to accept that. So what should they do? Let's go through the options. Option A, issue the unmodified opinion as requested to maintain the client relationship. Option B, report management's refusal to the appropriate regulatory authorities and proceed with issuing the modified report. Option C, withdraw from the engagement as management's refusal to accept the modified report undermines the auditor's ability to perform an independent audit. And then option D, include an emphasis of matter paragraph instead of modifying the opinion, as this is sufficient to disclose the issue. All right, so which one of these is going to be the answer? Again, if you don't really know very much about the opinions yet, that's okay, but kind of based on what we've learned so far, you might be able to kind of think through this. So pause the video if you want to, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is C, withdraw from the engagement as management's refusal to accept the modified report undermines the auditor's ability to perform an independent audit. Okay, so that's the answer. Now, I think that there's a little bit too much on the screen right now, so I'm going to scroll down just so we can see a little bit more. Okay, I think we can see everything now, so let's go ahead and go through the explanation. If management refuses to accept the auditor's modified report due to material non-compliance, the auditor should withdraw from the engagement because they cannot issue an unmodified opinion under these circumstances. An auditor must maintain independence and professional integrity, and if management prevents them from properly reporting on financial statements, withdrawal is the appropriate response. Let's talk about other audit opinions. Again, we haven't talked about these very much, and this is just a small overview, and we'll eventually get to these when we get further into the blueprints. But let's talk about the other audit opinions that might happen in these situations. There might be a qualified opinion. This is issued when non-compliance leads to a material misstatement that is not pervasive. So there's something wrong, but again, it's not affecting like a ton of different parts of the organization. There's an adverse opinion. That would be issued when non-compliance results in a pervasive material misstatement that makes the financial statements misleading. So a big problem makes, again, the financial statements misleading. That would be an adverse opinion. Now let's talk about disclaimer of opinion. This is issued when the auditor cannot obtain sufficient appropriate evidence about non-compliance, resulting in a pervasive scope limitation. So if they can't find enough evidence to prove that there is non-compliance or to kind of understand the non-compliance, then they might have a disclaimer of opinion. And then there's unmodified opinion with an emphasis of matter paragraph, and that was one of the options, right? But it's not the correct one. This is used when the auditor highlights an important issue, but it does not result in a material misstatement. Let's talk about the other incorrect options, and they kind of have to do with these other audit opinions. Option A was incorrect because issuing an unmodified opinion when a material misstatement exists violates professional standards. You can't do that. Option B was incorrect because while reporting to regulators may be required in some cases, the auditor's primary course of action here is withdrawal. So that's the first thing that they do. They need to withdraw from the engagement because they can't be dealing with a management who refuses to accept the opinion that the auditor gives. And option D was incorrect because an emphasis of matter paragraph is not a substitute for modifying the opinion when noncompliance results in a material misstatement. So that's not enough if there is really a material misstatement due to noncompliance with a law or a regulation or something like that. Now, with that, we've learned a lot in 5 questions about the responsibilities that auditors have when it comes to laws and regulations for the clients they're auditing. Now, before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the material, you will notice the things that keep popping up in the questions. You've seen 2 or 3 or 4 questions trying to teach you about the auditor's responsibility compared to management's responsibility, such as, again, managers are the ones in charge of trying to be compliant, things like that. You notice these popping up in the questions over and over again, so you take the time to write these out as pillar topics in your own words so that you know what is most important for exam day. And as you're doing this each day, you're building your own personal repository based on the questions that you went through of the most important things that you need to know for the exam written in your own words. So let's go ahead and look at the pillar topics. I already have them pulled up this time instead of having to go to them like I usually do. So let's talk about them. First off, management's responsibility for compliance. Auditors are not responsible for preventing noncompliance with laws and regulations. Ensuring compliance is the responsibility of management. Let's talk about reasonable assurance. And again, this is something we've talked about in multiple videos. Auditors provide reasonable assurance that the financial statements are free from material misstatement, and that includes due to noncompliance, but do not guarantee full compliance with all laws. Now let's talk about the auditor's response to potential noncompliance. If an auditor becomes aware of potential noncompliance, they must obtain an understanding of the issue, evaluate its impact on the financial statements, and perform procedures to verify whether noncompliance actually occurred. Now let's talk about auditors not determining the actual noncompliance. And that might seem a little bit confusing, like the auditor is looking for noncompliance. So again, they have to understand relatively the laws and regulations so that they can kind of think, hey, I think there's some noncompliance here. But again, they're not the ones saying this is noncompliance with the law. They're not the ones ruling that. So again, while auditors assess the financial statement impact of noncompliance, they do not make the final determination of whether a violation has occurred. They might think it has occurred, but again, they're not the one making that decision. That decision is made by a court or regulatory authority. And then finally, withdrawal for refused modifications. If a client refuses to accept a modified audit report due to noncompliance, the auditor should withdraw from the engagement, as issuing an unmodified opinion in such cases would violate professional standards. And with that, we've gone over the pillar topics for this video. Remember, in this video, we're only going over 5 questions for the YouTube version and for the member version, but typically the member version has an additional 5 questions so that members can get a little bit more practice. This was kind of a smaller topic, so I felt like 5 questions was plenty. We didn't need to do an extra 5. But again, usually members get access to the full 10 question videos. So if you like this and you like our other videos, make sure you check out becoming a SuperFast CPA Pro member, because again, they get access to the full 10 question videos. They get access to something called the Pro course, where Nate explains in depth exactly what you're supposed to be doing every single day to pass the exams. It's something you don't want to miss. And the best way to learn about becoming a SuperFast CPA Pro member is actually by going to SuperfastCPA.com and signing up for our free 1-hour webinar training. Again, it's free, it's 1 hour, and we will teach you in that 1 hour the key ingredients to passing the CPA exam, and it will give you a good path to learning more about SuperFast CPA and becoming a SuperFast CPA Pro member. Now, with all that, I hope you liked the video. If you did, make sure to like it and leave a comment. I hope this was all helpful, and I will see you in the next video.